You want to retire early, but you feel like you're stuck in the middle class grind? Well, in today's video, we're covering 6 expert backed strategies that you can use to retire early, even if you don't have a high income. Popular news articles about retirement savings can be discouraging to middle class Americans who are still saving up. With headlines such as, "Is $1 million enough to retire?" It's easy to assume that you can only retire early if you're wealthy. I can tell you from firsthand experience that most people don't need anywhere near that, but you do need to be smart about your finances if you want to retire early. So let's dive in. While it's not the most fun topic to think about, the first thing that you need to do if you want to retire early is to pay off any high interest debt, such as credit cards or high interest personal loans. Credit card interest rates can often be over 20% per year, which can significantly hinder your ability to build wealth and ultimately retire early. If you have multiple cards or loans with balances that you need to pay down, there's two main methods out there for tackling your debt. Number one is the avalanche method, which is where you prioritize the cards or loans with the highest interest rate first. Number two is the snowball method, which is where you start with the smallest balances and try to build momentum by paying them off that way. With the exception of investing just enough to get your company's 401k match, you generally don't want to invest any money until you get this high interest rate debt paid down, because the interest rate that you're paying on your credit cards is costing you more than you could earn by investing in the market. The second thing that you want to do to set yourself up for success is build an emergency fund if you don't have one already. A common rule of thumb is to have 3 to 6 months worth of your fixed and variable expenses set aside in cash, either in a high yield savings account or your bank account. This money should be used for quick and easy access in the event that something unexpected comes up, so that you don't have to put it on a credit card where you're going to be paying interest on it. Everyone's situation is different, of course, so don't just follow this rule of thumb blindly. For example, if you're in a career where you have volatile income, such as a sales career, maybe it's real estate, you may want to have closer to 12 months in a emergency savings account, because you never know what your income is going to be from one month to the next. So just apply some logic here and maybe set aside 6 to 12 months worth in an emergency fund if you think you're going to need a bigger cushion, to avoid putting any unexpected expenses on a credit card. Tip number 3 would be to save money in all 3 different tax buckets as you progress throughout your career and prepare for an early retirement. The 3 tax buckets that any investment account falls into are tax deferred, which would be your pre-tax 401ks and traditional IRAs; tax free, which would be your Roth IRAs and HSAs; and then there's taxable, which is an ordinary brokerage account. And taxable just means your interest, your dividends, and your capital gains are taxable in the year they occur, unlike the other 2 buckets. The reason why it's so important to contribute to all 3 of these tax buckets rather than just to one is because you want to have the ultimate flexibility and optionality of where to pull funds from when you retire early. For example, if all of your money is in that tax deferred bucket and you want to retire before the age of 59 and a half, any money that you pull from that account is going to be subject to income taxes and a 10% early withdrawal penalty, with some exceptions. Alternatively, if you contributed to a Roth account as well and a taxable brokerage account, you can withdraw your Roth contributions tax and penalty free at any time, no matter what age you are. And in your taxable brokerage accounts, you get favorable tax treatment on your long-term capital gains and qualified dividends, which are going to have lower tax rates than your ordinary income tax bracket. This can also be really useful for qualifying for premium tax credits when you need to buy health insurance on the marketplace, because if you're retiring early, the assumption is that you're not going to qualify for Medicare just yet. So by keeping your taxable income low on paper by utilizing these 3 different tax buckets, you could significantly reduce your out-of-pocket healthcare costs for health insurance when you retire early. Tip number 4 is to lower your fixed expenses and simultaneously accelerate your retirement savings. The truth of the matter is, if you want to retire early, no matter how much money you make or how much money you have, you need to save more than a traditional retiree would. The good news is that the lower you keep your fixed expenses, the more of your additional income you can save for your early retirement. So when I say keep your fixed expenses low, I mean try to avoid lifestyle creep. If you get a raise at work, don't immediately go shopping for a new car. If you pay your car off, try to keep it for a while, and instead of taking out a new car loan, use that money to put towards your investment accounts. Use a budgeting app if you don't have one already to track your spending. Cancel subscriptions you're not using. It all adds up over time. And remember, the more of your income that you save, the less that you need to replace in order to retire early. Tip number 5 is to use diversified investments and keep taxes and fees as low as possible. One of the biggest mistakes I see people make, whether it's middle class or otherwise, is trying to outsmart the stock market by picking stocks, thinking that you're going to pick the next Apple or Google, when in reality, it's almost impossible to do with any sort of consistency. So by buying index funds, you're basically buying the entire market. You don't have to guess which stock is going to do the best, because over time, generally the stock market will go up as a whole. Low-cost ETFs are a good way to keep more of your money in your pocket rather than paying actively managed mutual funds, which have not been shown to really consistently beat the market after fees. ETFs are also low turnover investments, meaning they don't really trade a whole lot under the surface, which creates less taxes and less drag on your portfolio returns over time. Also, make sure that you're investing in the right type of investments for your long-term retirement accounts. A lot of people like the safety and security of earning about 4% on a CD or a money market fund at the moment, but over time, that's not going to do much for you compared to investing in the stock market, which has historically returned an average of about 10% per year over long periods of time. For example, if you invested $50,000 today into a money market fund earning 4%, which by the way, these rates are not going to last forever, you'd have about $235,000 at the end of 30 years. If you had invested that money in the stock market, and let's conservatively say that you earn 8% compared to the historical 10%, you'd have over $695,000. So again, the stock market is going to do much better at outpacing inflation and making sure that you have that purchasing power if you want to retire early. Obviously, the stock market comes with more short-term volatility, so you need to be comfortable with swings up and down in your account balance. But generally speaking, that's going to be the best bet for outpacing inflation and growing your account balance over time. And finally, if you're middle class and you want to retire early, you may want to assume a lower withdrawal rate than you would if you were retiring at a traditional retirement age. If you're not familiar with the 4% rule, it says that you can expect to withdraw about 4% of your account balance at the beginning of retirement and then adjust that amount for inflation each year, with a very low likelihood that you're going to run out of money over a 30-year retirement period. The important part is that last piece, the 30-year retirement period. If you're retiring early, you might have a 35 or 40-year retirement period, making the 4% rule slightly more risky. So if you're planning to retire at age 50, you may want to use a lower withdrawal rate, such as 3.5 or 3%, just to reduce your odds of running out of money over that retirement period. You can reverse engineer this rule by taking your expected retirement living expenses and dividing by 0.03 or 0.035 to determine how much you would need saved in order to safely withdraw that amount each year over your retirement. So I hope this video was helpful and gave you some encouragement that you can take some action steps today to set yourself on a path to retire early. If you think you have enough saved for retirement, but you're not quite confident enough yet to pull the trigger, I do offer a free retirement assessment for anybody that's considering working with us here at Spark Wealth Advisors. You can click the link in the description below this video to be brought to my website, answer a few questions for me, and then schedule a time to talk. Thanks for watching this video, and we will see you in the next one.